Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Hello, everybody. I'm Thane Stenner with Stenner Wealth Partners of CG Wealth Management, and I'm the host of today's BNN Bloomberg SmartWealth podcast, which is a monthly podcast where I get to interview thought leaders in different areas, industries, and on the entrepreneurial front. My special guest today is Tony Dwyer. He's with our firm, Canaccord Genuity. He's the chief market strategist. He's been with the firm a lot of years and he has a very good reputation of kind of distilling down a lot of the macroeconomic items out there today, but mixing it with some tactical market guidance. And I have to tell you, he's a very good research source for us here at the firm. So, you may have seen Tony on CNBC. He's a regular guest there. He's also on Bloomberg on a regular basis. And we're very excited to have him on with us today during his very busy schedule. So welcome, Tony. Thanks for joining us.
Great. Thanks for having me, Thane.
So, there's a lot of different areas that I think we could begin. But before we kind of jump right in, Tony, maybe just give the audience a little bit of a background on yourself, kind of how long you've been in this investment field and kind of in your current role with Canaccord Genuity.
Sure. I came to Wall Street in May of 1987, and everything was wonderful. It was up and to the right, 30% gain and I was a political science major out of a small school in upstate New York called Lemoyne College. So I wasn't a market expert. I wasn't trained in economics. I was just, they needed people, frankly, at the time to fill seats to do the work. And that was before there was the internet or anything else. So by August of 87, the market made its peak. And we know what happened after that with a great market crash. So it was a tumultuous year to come into the business. And what I found was that I ended up having what guided my career choice. Now, I had a choice being a research analyst for individual stocks or being somehow a strategist. And I was very blessed, Thane, to work for a group of people that were still are, some of them, very highly regarded at the time. So I was in charge of summarizing what the economists said, what the technicians said, and what the portfolio strategist said. So I was a liaison that allowed me to look into the overall landscape for the macro economy, the tactical market environment, and overall economics. So that's how I decided that's what I wanted to do based on the reactions I saw when the market surged and then crashed.
Excellent. Very good. So I guess in this role, what do you enjoy the most about this role that you're doing currently at this point in your career?
Well, I really love doing stuff like this where you get time. I've been doing TV, and I'll get into that first. I've been doing television before there was financial television. Back in the early 1990s, there was a gentleman in New York called Larry. His name was Larry Wachtel. Now, Larry Wachtel, a lot of people still remember. He was at Prudential Beige, where I was. I worked for him at that time. And he was known as the strategist of Wall Street. He was the only real research guy that went on there, and it was Financial News Network. There was no CNBC. There was no Fox anything but Fox Business, or Bloomberg Business TV. So he hurt his knee one time, and I was the guy that would answer all his calls. I mean, the man must have gotten a bazillion calls. I would answer his calls, and he said to the FNN Financial News Network people at the time, "Give the kid a shot." So I started doing TV before there really was TV. Now, if you've got any opinion and a heartbeat, they have you come on. So I don't think it's as meaningful as it used to be, but I do love this kind of format where I get more than two sentences in before being interrupted, and you get to actually give a full rendition of what you're thinking.
Well,
And
exactly.
I love interacting with our wealth management group, which you're part of, and the client base within them, doing the public talks that we do.
Excellent. Well done. And it was good seeing you a couple months ago, early October, where you were telling our full National Business Conference in Toronto about how you felt the markets were kind of beaten down a little bit and that they should rally, into the new year. And so your call was bang on, and markets have rallied between 10 and 13%, depends on the index. So, and I have to tell you, your research we follow very closely, and even though you and I don't talk that often, the reality is you've got some really good, very good research that kind of comes out for the firm. So thank you for that. So, moving on to maybe a little bit of a recap of 2023, what surprised you about the markets in 2023? And I know it's December 12th today, 2023, so we're not quite finished the year yet, but what has surprised you so far?
Well, I think what surprised me, and I think myself and a lot of other people have not maybe emphasized enough, is how the private market, like private credit, may be buffering some of the bank lending that is very
Hmm.
weak. So the fact that we, given the fastest rate hike cycle in history into a generationally levered system, while engaged in quantitative tightening, we still have economic growth. So I'm frankly surprised we haven't, with the inversions of the yield curve. I'm a little bit surprised we haven't gone into recession yet, but I still
Gotcha.
believe we will.
Yeah. So basically, it's kind of a theme for 2024. I take it that, the assumption is that we will go into recession, but I guess,
Well,
there's a lot.
Thane, one thing that I would say I'm very surprised at is like you'll ask me or somebody would ask me, what do you think of the market? Well, you've got to now define the market
Yes.
because there's the private market and there's the public market. In the public market, you have the top 10 stocks versus everything else.
Hmm.
And that so if you judge by a S&P 500 call, I couldn't have been more wrong. It's up 20%. Right?
Mm.
I didn't expect a 20% move. But when you take those out, going into that October call for a year-end rally, you actually were down for most indices. The 8 of the 11 S&P sectors were negative on the year. Now that set the stage for the rally that you referenced, and I'm, blessed to have
Yes.
been able to call that. But ultimately, you can't go into the end of October in a year and say, wow, what a great year when everything but 7 stocks, not everything, but the vast majority of stocks are flat to down on the year. Now that's changed with this rally a little bit, but I think that is what surprised me is how bifurcated the market is.
Gotcha. Your group just published a market strategy piece called The Zombie Killer. Tell our listeners and viewers a little bit more about that and kind of the key tenets of that research piece just released.
Well, thanks. So the zombie, if anything, I love doing my titles. So the zombie killer, who doesn't love a good zombie movie, right? I love World War Z with Brad Pitt. I thought that was a good movie. And I love Scooby-Doo Zombie Island, which was an animated series. So, it's just when you want to really, well, be brain dead, you watch zombie movies. So, so, so I was thinking about the current environment where there's a debate whether we're going to see a soft landing, a hard landing, no landing. And for the listeners and viewers, a hard landing means recession. A soft landing means slow down, then reacceleration. A no landing is we're just up, just great all the time. So our call has been for a recession. The zombie is the fact that you're in this state where you can't prove a recession yet, and you can't prove a soft landing yet. You're not negative in that economic activity, but you're not growing robustly. We had a good third quarter in the US with GDP up over 5%, but in the fourth quarter, it looks to be at best up 1%. Clear signs that we're still in manufacturing recession, signs that we're peaking out in non-residential construction. The government's not going to give us any new money after this most recent package. There's still some fiscal stimulus there. And the consumer's slowing. So the
Hmm.
zombie economy is one that it's not dead, it's not alive. You don't know what it is. It's still kind of walking. And you've got to me, it's 20 times the earnings for the S&P 500. If you exclude the top 7, it's 17 to 18 times. That's still pretty rich when you don't have a more robust and clear-cut economic outlook with limited inflation. So we're in this kind of zombie environment where you don't know which way that it's going to go. So in a good zombie movie thing, what do you have? Yeah, well, you could kill the individual zombie, but the real way to do it is you got to figure out what caused it.
Yep.
Then you got to get a cure for it.
Mm-hmm.
And then you got to have a mass distribution of the cure.
Mm-hmm.
So the zombie in this case is a Fed that raised rates from 0 to 5% in a year and a half. That is the fastest rate hike cycle in history,
Mm.
faster than the 70s. So that's the cause of the zombies. The cure for the zombies is, well, lower rates. You got to have significantly lower interest rates. And then the mass distribution of that cure is if you have US Treasuries come down in yield significantly enough to kickstart increased mortgage activity, increase corporate credit activity, and increased employment. And
Now,
that kills
yeah,
zombies.
so like that seems to be starting to happen somewhat already. I mean, the 10-year US bond yield intraday, I think, peaked around 5.15%, or let's call it 5.1, just to
Yeah.
round down, and has moved down in the last 2 months pretty quickly to 4.3, 4 point in that range
At
today.
4.20 right now is
Okay,
where the
okay,
bond is.
excellent. So I mean, literally, longer term rates have dropped 9/10 of 1% pretty quickly. So is for 2024, it sounds like to me, you're kind of anticipating interest rates potentially coming down over the next 12 to 24 months more than maybe some are expecting. Would that be a fair comment?
It's a very fair comment. If inflation was the problem and it's reversing course to the point where it's coming down now as fast as it went up, yet the Fed has not moved, which means when you bring the 10-year not down to a 420 from a 5%, that means you're inverting the yield curve worse. You're making banking more difficult. So
Mm.
in that scenario, it's more likely to have a recession. So I wrote a piece a few months ago called Higher for Shorter.
Hmm.
Now, in the US, people are saying that the Fed should be higher for longer because inflation's sticky. Well, it's not. What if it's not? What if the Fed having interest rates as high as they are, they've already, just like they overstayed their accommodation, maybe since they do it every cycle but one, they've overstayed their
Tightening.
restriction,
Mm.
their tightening. And
Mm.
so our call is in the first part of the year, that comes into effect with economic output, a higher unemployment rate, that drops rates even more. And that allows the kickstart to get that next cycle going.
Gotcha. So would it also be fair to say that likely means a corrective phase for the equity markets before we base, and I guess longer term bonds are probably not a bad place to be in at this point if you had to anticipate?
I would say intermediate to longer term bonds are still pretty good. I mean, you're still getting a four. Remember,
Yeah.
the 10-year bond yield was a 0.5%. So
Yes.
getting 4.2% isn't so bad. But if you have a significant enough rally in the bond market, equities will outperform. So
Gotcha.
you'll still do well, especially if inflation comes down on a real return. But your equity market should do better. And again, Thane, this is really important to pass along to the listeners. That sounds insane to say because the S&P 500 is up 20%, but
Yes.
most stocks are not anywhere near it. The
Yeah.
Russell 2000 made a new cycle bear market low just 6 weeks ago.
Hmm.
Banks, same thing, same thing. KBW Bank Stock Index, new cycle low 6 weeks ago.
Hmm.
So there's a lot of room for equal weighted stocks, Russell 2000 small cap stocks, mid cap stocks, bank stocks for when we actually do that, get that kickstart to an improved outlook for money.
So let's circle back to our comment there on the small cap side. I would certainly agree with you. I mean, the small cap index, Russell, and just small caps in general seem like they've had a really tough go of things. So, um, just maybe talk about what small caps, how they tend to perform when their bull market kind of starts,
Yeah.
and like how long does that play out typically on a
So
small?
it's not that easy. I went back and I looked and it's inconsistent. It's not like small caps are underperforming so you know you're in a recession because that wasn't true. They started their improved relative outperformance in 1999. Right.
Mm,
So, and they
mm,
went, and it was the big caps coming down so hard that caused the relative outperformance. So, I
yes.
don't think there's an economic call to be made because of how badly small caps have done. I
Okay.
think the bigger call relative to small caps is the following. The top 10 stocks in the S&P 500 currently are about 34.3% of the index. So 34%, more than a third of the S&P 500 is just 10 stocks. So anytime you've been anywhere, this is the highest in history of the data that I can find going back to the early 1970s.
You're talking about concentration is highest in history.
Correct. So
Gotcha.
the concentration in the market of the top 10 stocks as a percent of market cap is a little bit above where it was in 1972, 73, and a lot above where it was in the dot-com. So when you look at what happened then through different kinds of economic activity, you went into a 15-year outperformance period for small versus large. Now, some of that was large came down really badly, and some of it was large went up less. But it was throughout either economic part of the economic cycle, it outperformed for 10 to 15 years. So I think that is going to be the likely occurrence once we finally turn the concentration in the market from peak.
We're just going to take a quick break. Please stay with us. We'll be right back.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. And should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF. The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. And should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. Let's get right back into the interview. Byron Weens, I'm sure you're familiar with, who recently passed away, but he was a long-time prognosticator. He had the 10, I think it was the 10 top surprises of the year he would kind of do fun forecast on. So what do you think? Okay, so you've given one surprise, I think, here, and that's that short-term interest rates may end up coming down much more than maybe what the markets are anticipating. What other surprises do you kind of ponder or think about for this upcoming 12-month period?
I would say that we actually go into a recession. I think that the consensus calls a soft landing. Listen, that's one. And then I think it's the relative outperformance, the degree of outperformance of small versus large. I think that's going to play into it pretty well, and just how well the average stock might just do.
Interesting. So I guess, so let's just talk about the top 10 stocks in the U.S. then, from a point of view of, do you think they'll kind of go sideways for the year? Do you think, everybody's got cracked crystal balls when it comes to this, but
we're all pulling it.
Yeah, exactly.
So I don't think there's a crystal ball. I think in this situation, it's going to depend on what Fed policy is. If Fed policy comes down enough and kickstarts the improved outlook for money, it'll be because they go up less. If the Fed stays higher for longer and makes it worse for lending, they'll go down more. So it really depends. The reason that people like me are always wrong in our prognostications for the 12 months ahead is we're trying to get the price right, we're trying to get the date right, and we're trying to get the earnings right. And that's without any knowledge of what the Federal Reserve is going to do. So I find that a silly tactic. We're forced to do it. I don't do it. I work at a great enough firm that doesn't force me to do it. I think what we have to do in this business is respond to what the interest rate environment is doing to economic output when you look forward. And then from there, that determines how much and which ones.
Gotcha.
Right.
Gotcha.
And that's what has caused this incredible outperformance of the top 10 stocks relative to everything else. They call it the Mag 7 in financial TV, now the top 7 stocks. That used to be, what the heck was the name?
Nifty 50 or
No,
FANGs. You're talking FANG.
FANG
Yep.
Plus, right? So, what caused that is weak growth. If you have weak growth, you pay up for predictable growth, and that's what those stocks have done.
Gotcha.
So I think there's risk in those names to the benefit of the rest of the market, but you're going to need the Fed to cooperate with that.
Gotcha. So does this time period right now feel like another time period in your career? Like, is it similar enough to, I don't know, the dot-com period? Is it?
No,
No?
It doesn't. You know why? Because in my career, we've never had inflation like we had. But then in my career, we've never had the private credit market. So the private credit market in the last 10 years has grown from about 0 to $1.5 trillion. Okay, now that's non-regulated lending. That's not overseen by the Fed. There's no data that shows exactly where and what it is. That didn't really exist before. So if you take us back and you invert the yield curve like we have historically, it shuts down lending. Banks have to sell their assets to fortify their balance sheet. That hits the market and everything goes whoosh, right? In this situation, we've had some of those private credit funds buy those assets without having to have them go to market. So that right there is what's different. There's a few things that are different, but ultimately, it's a consumption-based economy. There's signs that you're already at full employment. The soft landing in 1995 that the market hopes and investors hopes happens, you still had, even with a slowdown, you were only 50% of the way through the improvement in the unemployment rate from the 1990 recession to where we're going to be by dot-com recession. So you still had, of course you don't know that at the time, but you had a significant improvement still to come in employment. I'm hard pressed to say that when unemployment's at 3.7% and actually the trajectory is higher off of the bottom. So is there a time that it's like, I think every period is somewhat unique, but it always comes down to the same. What's the outlook for money? And what creates an improved outlook for money is you get it one of three ways. You borrow it from an institution, private creditor or bank, you raise it in the capital markets, or you earn it. Right now, we're just past full employment. Capital markets remain largely shut down. I think that'll change if the Fed eases enough. And if the Fed eases enough, bank lending will start again. And that's the bull story. And the problem is it takes more than 70 basis points in the 10-year when it's up from 0.5 to 5.
Correct.
Coming back to 4.2 is nice. It kickstarts a rally. I don't know that it's enough to kickstart a reacceleration in the economy.
Gotcha. Very well said. So let's just go up to 36,000 feet for a moment. You live in the U.S. You study mostly the U.S. Do you look at other global markets globally, and kind of what's just top-down perspective? Other areas that are value outside of the United States, in your opinion?
I don't want to pretend to be a Martin Roberge is our portfolio strategist. He does more of a global look, but so here's my problem with the global data as a macro guy. It's sort of like when you go into a city, it's better to go in with somebody local than just to guess at where you're walking around, right? And that's true from an economic and macroeconomic framework as well, because the data in the US is the most trusted data globally, I believe. It is horrible and subject to significant revision, and that's the best data. So the idea that I'm going to use less good data and think that I'm going to be able to figure it out when I'm not local to it is truly the definition of insanity to me. So I can make currency, broad currency looks and things like that, but I don't think anybody should, unless you're local, pretend to be this global strategist knowing the data.
Okay, so with that in mind, your northern neighbor, us Canadians up here, how do you, Canada's very reliant upon the U.S. How do you view the Canadian markets versus the U.S. markets, just from a um, compare, contrast the U.S.?
Well, again, I defer to Martin, who's our Canadian strategist, but
Yep.
okay, so what are the problems in Canada? Higher interest rates are killing the mortgage activity,
Yep.
and commodities are getting smoked. The
Yep.
Bloomberg Commodity Index, as we tape this, is at a new low.
Yep.
So if your two main drivers are having a difficult time, so are the markets. Now that, again, a lot of stocks reflect that, Shane. Like
Hmm.
I'm often to say I've been on the more defensive nature for the last 2 years. Historically, I'm known as being pretty bullish most of the time, and that's true because money's available most of the time,
Yep.
right? And in the current instance, whether it's in Canada, the U.S., the Eurozone,
Hmm.
that's not true. Money is not readily available right now.
Well, being defensive the last 2 years hasn't actually been a bad thing, right? The S&P 500 and NASDAQ, literally over the last 2 years and 5 months,
Still down.
is still slightly down or kind of flattish.
And the
So it's been,
Russell way worse.
yeah,
So, to me, sitting in cash as rates have gone up, and not all cash, you don't go into all cash. I call it light and tight. You don't need to deviate that much. But, sitting in cash and getting anywhere between 3 and 5% over that period of time, that's been okay. Now the challenge, so what, now what?
yeah.
Right? The challenge becomes what do you do from current levels? And that's where I got to find I'm struggling with that because the stock market is quote unquote telling us something. I don't believe it because I can't identify the improved outlook for money. I
Got
can,
it.
like you said, then as you know, last year, we make pretty good tactical calls along the way when the market
Yep.
gets oversold enough and then it bounces up and everybody gets bullish. Everybody gets bearish October 27th. They're giving up on the year-end rally right when it's time to buy.
Hmm.
And now we're jumping, closer to 15% than 10 for some indices. And now you want to buy? There's got to be a fundamental reason to do either one,
Hmm.
right? And that's where I'm challenged still a little bit is finding that improved outlook for money that's going to be strong enough to generate a new reacceleration. Otherwise, you're just going back to square one. You're in the zombie forever. How
Hmm.
do you soft landing, hard landing, whatever kind of landing? How do you get that next stage of reacceleration? And you need that money.
Hmm.
That's my problem.
Gotcha. Gotcha. So, we, our particular team, we focus with clients that are 10 million plus portfolios and 25 million net worth. So they're top 1% of investors kind of across the wealth curve. So if, let's say somebody handed you $10 million today, how, I'm not talking about individual specific things here, but how would you start to allocate? Like how much cash, how much bonds?
So I service so many different clients. I refuse to answer the question, Your
Okay.
Honor. I would say, Senator, I refuse. And here's the reason. My constituent base is you guys.
Yep.
You have such a diverse client base, impossible to make that call without knowing them. I have institutional long only clients that look at things for the next 5 years.
Yep.
I have hedge funds and partnerships that look at it for the next 5 minutes. So
Gotcha.
there's a difference in the clientele. So you really have to define what kind of client for that, which you did by saying the top 1%.
Yep. Yep.
And it depends on what you're in now. If you're 100% long now and you gave me that money, I might sit with it. If you're 100% cash right now, I may allocate it to small and mid and some of the early cycle names looking for an improved outlook for money in the early part of next year. So it truly depends on what the credit market does and the type of account.
Gotcha. Okay. So very good judo move, Tony. Very good. And I
Buddy,
agree.
I've done this since
And I have to.
1991.
I know. I 100% agree with you. But I'm gonna pivot that just for fun with you. You personally, based upon your risk profile, which I don't,
Yep.
how would you allocate that today yourself?
Well, how would I allocate that today? For me, I would, I have private investments. I have my 401k. I
Yep.
have an allocation towards small and mid that's
Yep.
just, recently started
Yep.
because I have that longer term view there.
Yep.
I think again, it's not about what I would do because I may be different. I have kids just out of college. Thank God that's over. Whereas a lot of people don't. A lot of your clients probably still have kids going to college. How you allocate capital isn't just about the gain you can get. It's what if you need it?
Correct.
And we forget that.
Yep.
So, and I'm often say I have a website, through Canaccord Dwyerstrategy.com.
Yep.
And on it, I often say, I will not ever tell people what to do. I will not, there's no way that you could phrase it, Thane, that you could tell me to tell people what to do.
Okay, you're
I
pushing
will,
back. You're
but
pushing back.
but here's what I'll do. I will always give people a guide as to how we're thinking about things with integrity and data. All too often, people like me come on forums like this and say, I think, or in my opinion. There is no think, there's data. Like I
Hmm.
like to say,
Hmm.
we have our monthly publication is called the Picture Book because
Yep.
if I'm writing a lot of words, I'm making it up.
Hmm.
There should be history to support and data to support the views that we make. And then you can use that view and allocate capital to your various different kind of clients in the way that makes the most sense.
I 100% agree with you, but I'd like to add something, hear your feedback to this. Data plus sentiment, right? The data, a lot of like data comes out, you get the latest data, it's accurate, it's math. I find, I've been investing since I was 10 years, 9 years old, since because my father was in the business for a long time as an advisor. One of the things he shared with me over time was the actual sentiment of the market when people get too
Oh, yeah.
fearful or too greedy. So the data is extremely important, as you point out, but sentiment. So how would you describe sentiment right now?
Yeah,
December
but that's
12th, 2000.
presented as data. University of Michigan,
Good
put
point.
call ratio,
Good
technical
point.
indicators, oscillators,
Good point.
bullish ratios, things that can be shown in data. And right now, so on October 27th, when we wrote a piece called The Stage is Set for a Rally, it
Yep.
was based on the sentiment.
Yep.
You would never become, it's very rare, not never, it's very rare to get that oversold and pessimistic toward the stock market. If you remember back just 6 weeks
Yep.
ago, it seems like a
Absolutely.
lifetime ago. I
Yep.
mean, the Russell 2000 was making a new cycle low, broke that October 22 low. Same with the banks. Average stock was down more than 30% from its 52-week high, forget all-time
Hmm.
high. It was a bad time. The
Hmm.
sentiment was bad, but here's the key to sentiment. Do you have a catalyst identifiable to turn it? And in that time, we did.
Hmm.
We had Janet Yellen was about to announce the new Treasury refunding. She was a Fed chair. She knows damn well if she had increased the issuance of long duration assets,
Hmm.
that rates were going to go up again.
Hmm.
Right? You were already up on a spike, and people were worried. People were talking about 6% 10-year bond. Right.
Hmm.
So
Hmm.
there was an identifiable catalyst in the Treasury refunding announcement. There was a Fed meeting that Wednesday. There was
Hmm.
the payroll employment report that Friday. I had three identifiable catalysts and data points
Hmm.
that could be coupled with the sentiment at the time and
Yes.
say, wow, this is good.
Hmm.
Now, what do we have today as we record this? We have the rally that we were looking for plus some.
Hmm.
You have a very high level of bullishness again.
Hmm.
All of my technical indicators are in an extreme overbought, even the intermediate term ones.
Hmm.
And everybody's betting on the soft landing. 6 weeks ago, everybody's betting on a recession and a
Hmm.
spike in interest rates.
Yep.
So the sentiment now is kind of the opposite. I would say suggest is the opposite of where it was 6 weeks ago. So that's where we've neutralized our trading call and just want to wait it out to see what happens with the Fed.
Gotcha. Very good comments. So let's wrap up with something that's really big picture in your career. Um, what would be the top two or three things you've learned about the markets and trying to make money in the markets?
I'm an emotional being, no matter how long I do it. I feel like a dope when it's going against me, and I feel smart when it's going with me. And both are probably wrong. It's somewhere in the middle. That's number one. Number two, I've learned that the data is so highly revised that you can't make an investment decision on current data. You have to look at the revised data and the trend of the data, and that'll give you a better discussion point. And the most important one is I need to remain teachable. I need to learn how to learn. Right? I can't try to get rich quick. I can't try to make it all. I don't want to be the guy. I just want to help people in their process of how they're going to allocate their capital for when they need it and how they want to grow it. And I have a great team in you and the firm to allow me to do that.
Fantastic. Excellent comments. Well, Tony, I know you have a very busy schedule these days. I think you're on CNBC next week, and everybody's kind of wanting to get your time, but I really want to thank you on behalf of the viewers and the listeners today, and excellent comments, and thanks for, once again, making the time.
My pleasure, buddy. And thanks for having me.
Happy holidays and Happy New Year.
Great holiday for everybody.
Excellent. Thanks, Tony. Please feel free to go to our website, StennerWealthPartners.com, to see more information, see the recordings of prior podcasts. This was the last podcast for season 2, and very pleased to announce that we're renewed for season 3 in 2024. So really looking forward to kind of bringing these insights and interesting guests to you each month. So listen in, download on your favorite platform. And again, everybody have a wonderful 2024.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF. The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.